This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only. Now, here's Shane and Deanna.
G'day everyone, here we are again. This week you've got a double episode.
Lucky you.
Lucky you and lucky us, and that was because of the events in the US around Donald Trump, the assassination attempt, and obviously the US election is coming into big focus. I must admit it is causing a little bit of agitation amongst investors, but so far share markets seem to be ignoring it. A bit of volatility sometimes in the bond markets or fixed interest markets, but what do you make of it, Deanna, in terms of, what it means for the US election, the assassination attempt, but of course we're not geopolitical analysts, but also how come markets seem to be largely ignoring it?
Well, we're not geopolitical analysts, but geopolitics is quite important right now, and I think it has been since the pandemic in the world of economics, and it definitely drives markets. So it is quite important to look at these things. If you look at what's happened after the attempted assassination, Trump's probability of winning the presidency in November has gone up to just under 70%, I think, on the latest measure. And that, some are saying, is leading to a Trump trade in markets, which is leading to shares higher. But I think that there are other things going on as well. Talk of lower interest rates in the US and around the world, better inflation data around the world leading to those interest rate expectations is also leading to high share markets.
So those things are sort of swamping any uncertainty that might come from a change of government.
I think it's hard to know. A lot of people might be focusing, a lot of investors might be focusing on some of the positives of a Trump presidency. So he's campaigning to reduce the corporate tax rate, to increase investment in the US economy, to increase jobs, and he's campaigning on that sort of platform. But at the same time, there are some longer term potential negatives from a Trump presidency 2.0, and they're mainly around increasing taxes through tariffs. So what do you think are going to be some of the impacts of some of the tariff talk that he's been campaigning on?
Yeah, I think they're the issues. You got these positives under Trump, which is more like Reaganomics, supply side sort of stuff, lower tax rates, deregulation. And we know historically that those things are liked by share markets and they can boost economic activity. And historically, we saw that in the first term of Trump 1, that is, 2017 share market surged on the back of the lower tax rates at the time and also deregulation. I guess the question this time is the timing, that the more questionable aspects of Trump policies are his tariff hikes. He's talking about a 10% tariff on imports from anywhere, including Australia, presumably, and a 60% tariff on imports from China. That's a massive increase from where we are today in terms of US tariffs.
So that would take the average US tariff rate to its highest since about the 1930s, I think.
I think it would. I think you might have done that calculation in the note you did on that. So yeah. I think the average tariffs in the US at the moment is something like 3%, or they're relatively low. Obviously, all of the tariffs that Trump put on back in 2018 on China, they're still there. And Biden is talking about adding to them a little bit. But in the great scheme of things, it's relatively small. What Trump 2 is talking about is much, much bigger. I noticed in the debate, which was a depressing viewing a couple of weeks ago, that Trump was asked by one of the moderators, surely tariffs are going to add to inflation. He says, no, foreigners will pay for it. But the reality is that consumers in your home country will pay for it because the importer of the item, whatever it is, whether it's an electric car from China or a small consumer good that goes into Walmart, will then pass that cost increase on to the retailer, who will then try and pass it on to the consumer.
And then, of course, a lot of these companies like Apple or Microsoft, they use a lot of parts that are manufactured in China or overseas. So they would then, a US company would be passing on the higher tariffs to US consumers.
They would, and that's how you get this inflationary boost. I guess there's also a flip side, though, is that other countries will retaliate and they'll put their tariffs up. Some people may have heard of Smoot-Hawley tariffs in the 1930s, which arguably made the Great Depression worse. So policymakers, I think, in the US thought, well, the way to resolve the issue here is put a tariff on all imports that will protect American workers. Guess what? Other countries did the same thing, And of course, there was less trade and the global economy wound down, so to speak. So that would be somewhat deflationary if you get that, and that partly explains why in the 1930s prices fell rather than rose. So that's certainly a big risk. There's other risks in there with Trump talking about, I'll just focus on the key ones, reducing the independence of the Fed. Trump didn't like the Fed raising interest rates in his first term.
Although now I think he's becoming a bit happier with Powell because he said that he will not get rid of Powell if he's re-elected in November.
I have heard that, but I sort of wonder whether it's just Trump's thought on the day.
Maybe he likes him because he's talking about lower interest rates.
It could be that. Property people often like low interest rates, and Trump is basically a property person, but amongst other things. But there is that aspect. But I know his campaign team have been working on ways to reduce the independence of the Fed. There's also talk that they will lower the level of immigrants coming into the US or repatriate people, which reduces the labour supply and could add to US inflation, that way be a high wages pressure. So there are some threats here, which the markets aren't so far focusing on. There's also the issue that if you cut tariffs or cut personal income taxes and your budget deficit blows out further, then that could be bad news for the bond market. So
is that why bond yields have been going up a bit this past week?
It could be. It's interesting to note that after the first debate where it looked like Trump won, we can all debate that one, but for all intents and purposes it looked like Trump won, his poll ratings went up and bond yields sold off initially after that. And similarly after the assassination attempt where there has been a surge in support for Trump, further surge, guess what? Bond yields have gone up. Now, of course, a few days later, the market forgets about it, but it is a warning that the bond market is getting a little bit twitchy about US public debt, which is breaching that 100% of GDP level, and their budget deficit is already around 6 or 7% of GDP. So if you get Trump-type policies, more tax cuts and so on, that could further blow out the US budget deficit, be bad news for bonds.
And lead to higher interest rates.
So there are some reasons for caution or concern here around President Trump. I also have a little bit of a nagging worry that I guess I was a teenager in the 70s, the 1970s to some degree were a bit of a backlash against the policies of the 50s and 60s. So suddenly workers said, we're sick of these low wages. We want higher wages. Central banks started to print money. We saw excessive regulation and all of those things showed up in lower growth, higher inflation in the 1970s, which wasn't a good time for share markets, unfortunately. And there is a risk that maybe we're going through something similar again with this surge towards populism. So that worries me a little bit, but by the same token, you could argue that hopefully common sense will prevail, that central banks have a better idea as to what to do to control inflation than they did back then, and so it should head off a worst case scenario. But it's something certainly to keep an eye on for us as investors.
And if Trump 1.0 was a guide, share markets didn't like the news of a trade war, and there was quite a big correction in share markets that year, although it also coincided with the time that the Fed was talking about higher interest rates. So again, it's hard to disentangle which was driving what. But I do think that if we got a full-blown global trade war, there would be a big negative for share markets, at least initially.
That's the thing. This is the confusing thing about the first Trump period. 2017, share market surge. So everyone was worried about Trump, but from the day he was elected, well into 2018, share markets actually did really well because he focused on the tax cuts and deregulation. Then in 2018, share markets fell into a bit of a hole because of the trade war at the time. So we know from that experience that, yes, markets like tax cuts. So he focuses on that, good news. But if he focuses on the trade war, then that could be bad news. And of course, it's all complicated by the budget deficit being a lot higher than it was back then. I guess the other point about all of this is that trying to forecast geopolitics, get it right, is really hard. It's often better to wait and see the reaction. There's been so many twists and turns in this US election that it could twist back the other way and turn out to be relatively benign. So it's very hard to react to these things in advance. Better, I think, often to sort of take advantage of the market reaction when it occurs, rather than try and forecast these things in advance, because you often get it wrong. Those people in 2016 who were forecasting a fall in share markets on the back of Trump winning got it totally wrong.
Yeah. Even though they might have forecast him winning correctly.
Even though they might have forecast him winning correctly. So getting these things right can be a bit hard. If you think about China, as long as I've been around, there's been talk of China trying to retake Taiwan and integrate it into broader China. And of course, here we are 30, 40 years later and we're still talking about it. So trying to forecast when these things occur and how they can unfold is very, very difficult for investors. So I think the best approach in all of these things is to take a long-term strategy and stick to it. If markets have a tumble, then you use the opportunities that throws up.
Thanks, everyone, and thanks, Shane. See you next time.
Thanks, Deanna. Take care.
For more info on Shane and Deanna's podcasts and reports, head to the Insights Hub at amp.com.au.